Hello, good afternoon everyone. Welcome to today's episode of Modesty's Money Masterclass, episode number 39, and this is season 2. How are you all and how is everyone doing today? Today is a very important one that we're going to be talking about the principles of investment principles, and this is a follow-on from what we've been doing since last week. Since the time I went for that program in Birmingham and Manchester, some of the knowledge that I shared there, I felt I should also share with a wider audience, like you guys on this platform, on this group, and wherever you're watching and listening from. So last week I focused on the principles of savings principles, and I promised that this week I'm going to be talking about the principles of investments, which was part of the knowledge I shared in those events. And after the principles of investments, we're going to look at the principles of insurance. Remember that this is based on the tripod of wealth building, which I mentioned, that are the things that makes your wealth building formidable: savings, investments, and insurance. So we dealt with savings last week. This week we're going to be dealing with investments, and after this we're going to be dealing with insurance. So today, let me just jump straight into this because we've got a lot to go through today. I've termed it the 12 commandments of investments. So I've kind of picked out 12 key principles of investment that I want us to focus on. And if you pay attention to these 12 key principles and let them and allow them be your guiding principles when you are investing, trust me, you will not go wrong with your investments, and you will not go wrong with your investment decisions. So these 12 commandments of investment that I mentioned, I'm going to run through them quickly because, trust me, each of these ones is enough to be a session's topic. I can devote one whole session to each of these 12 commandments I'm going to mention now. But I'm going to run through them quickly, and then maybe as the Spirit leads, subsequently in the days or months or years to come, I might choose to be picking them one after the other and be deliberating on them and breaking them down in its simplest form. But today, let's run them down quickly. All right, number one commandment of investments, the principles of investments, is to keep it simple. Keep it simple. Listen, investment, the best form of investment, from every study I've made, from every research I've made, from people that I've listened to who are investment experts, the best forms of investments are the ones that are kept simple. Complex investments, to be honest with you, they are riskier, and there is no evidence that they are more profitable and more beneficial than the simpler investments. And the only people who benefit from complex investments are the ones who create it. So certain financial experts are experts in creating complex investment products, and it is meant to bamboozle the investor. And the more bamboozled you are, the more scared you are, and kind of the more convinced you are that this investment is going to make me a lot of money. But the actual people who are going to make a lot of money off you are the people who created the complex investments, because they are going to charge you for the complexity, because they know you don't have the wherewithal, you don't have the knowledge, you do not have the expertise, you do not have the ability to break down the complexity of that investment. Therefore, they're going to charge you heavily for that. So in investments, keep your investments simple. And the best forms of investment that are simpler, or the simplest, are the ones that are passive. Passive investments are very simple. What are passive investments? The investment that you don't manage the investments yourself. For example, in fund management, right? You don't manage the funds, you don't manage day-to-day decision making of that investment. You don't decide basically what that money is put into, because you don't have the time, you don't have the expertise. You have a platform, or you have an avenue, you have a channel through which that investment is going. So you're passively investing. You just put your money in it and allow the people who are experts in running that investment to run it, while your job is to make sure you fund that investment and make that investment, active. So you're not actively involved in the management of the investment or in decision of where that investment is made. So passive investment is usually very simple, and in most cases, those passive investments actually outperform the active investment. But this is a very deep area that we cannot spend all day today going into it. But keep it in mind that when you are investing, please keep your investment simple, because complex investments have not proven to outperform simple investments over time. In fact, simple investments, mostly passive investments, outperform most of the actively managed funds according to evidences that are out there. Number 2 is to diversify your investments. Number 2 principle is to diversify your investment. That's the second commandment of investment. Now, there is no point you taking your investment and putting all your eggs in one basket. So when we talk about diversification can take many formats. Whatever form of investment that you're making, whether you're investing in properties or you're investing in stocks and shares, or you're investing in other forms of investment assets, there is need for you to diversify that investment. Even in one asset class like property, for example, there are different ways you can diversify your investments in properties. You can invest in houses, you can invest in flats, you can invest in bungalows, these are different types of properties. Even you can invest in certain parts of UK or up north or in the south, different kinds of diversification. If you're in the stocks market, you can invest in different sectors on the stock market. Even in stocks, there are mutual funds that have stocks, there are mutual funds that are mixed or balanced investment, there are mutual funds that are 100% stocks, there are mutual funds that are 100% bonds. You can mix up different, but in whatever asset class you're investing, do not put all your eggs in one basket. If you choose to invest in financial instruments, say like mutual funds, you can go into those mutual funds and say, I don't want to invest in 100% equity stocks funds only. I want to diversify it. I want to invest some part in equity stocks and some part in bonds and some of them in mutual funds. So you can mix these investments up, because what diversification does for you is that it neutralizes the risk and spreads it across for you, so that if this part of investment is not doing well, the other part is doing well. If this one is not doing well, the other one is doing well. It's a very basic principle of investment, but a lot of people ignore it, especially people who are greedy. The moment they see one investment opportunity that they feel is going to give them a lot of money, they dump all their money and all their resources into that investment, and then once that investment crashes, that's it. So in whatever asset class you're investing, please make sure you explore every diversification avenue that spreads the risk across the different assets that are in that asset class, so that you can make maximum you can take maximum advantage of that diversification purpose. Some people can also diversify through different asset classes. They can put some money in stocks, some in gold, some in property, some in other precious metals and all that. Spread it across, so that if this one is not doing well, that one is doing very well. It helps spread the risk across. Number 3 commandment of investment is to monitor inflation. You cannot be investing and be ignorant of inflation, because inflation is a major aspect of investment analysis. Nobody does investment analysis for you without taking into consideration the effect of inflation. Several investment analysts can project or predict what inflation is going to look like. The projection might be wrong, it might be right, but it has to be built into the module, it has to be built into the formula, it has to be built into the investment analysis concept, because inflation cannot be detached from investment. Inflation has the effect on assets. During inflation, assets rise in value. Inflation favors assets, but inflation does not favor consumption. In periods of inflation, people who have a consumerism attitude find consumer goods expensive. People who have assets can see that their assets are rising in value in periods of inflation. So you cannot be in investments and ignore inflation. When you are investing, look at, consider how inflation is going to affect that investment. Because inflation, what it does is that it wipes away the value of currencies, right? It makes currencies to depreciate in value. It devalues currencies, and if it does that, your investment, if it ignores inflation, what it means is that if the returns on your investments are below inflation or below the rate of inflation, you are not making money. You are not getting any wealthier. You're not getting any richer. In real terms, it simply means you're getting poorer because the returns on that investment are not outperforming inflation. But if inflation is if the returns on your investment are performing above inflation, above inflation, it simply means that in real terms you are making money. Because, for example, in the UK now, inflation rate is at 10.1%. If you're investing and the returns on your investment are less than 10.1%, in real terms you are poorer. Because inflation, it means that what you get from that investment cannot actually buy you the value of that return on that investment. The value of the money you are getting is less than what the current value of money is. That's a simple explanation. So when you are investing, always take into consideration the impact or the effect of inflation on your investments. Number 4, these principles of investment is to have a long-term approach to investments. Have a long-term approach to investments. If you want to invest and you don't have a long-term approach to investment, you are shooting yourself in the foot, because investment thrives with time. Investment needs time. Investment requires time. And for those who don't have long-term approach to investment, what they do is that they panic sell. Anytime there is a small shake in the market, they panic sell. And when they panic sell, they lose money. Trust me, you do not lose money in investment unless you sell that investment. So sometimes you might be hearing on the news or the media, Microsoft lost $12 billion of the value of their investment because of market turmoil. Amazon lost $13 billion. The only way and the only time you lose money in investment is when you sell, right? So the value of that investment could temporarily go down because of market turmoil. But as long as you are still holding that asset, you are not losing it, you have not lost anything. The asset might have lost value temporarily, but to realize that loss, you have to actually sell that asset. But if you're not selling that asset, yes, on the face value, it's lost value. But if you hold that asset long enough, you might actually, right, exactly, it needs time to mature. You might actually regain whatever that investment has lost on face value because you are holding it. So you have to have a long-term approach to investment. When you get into investment, be ready to be in there for the long term. You are not there to just take a short benefit or short profit and then run away. If you do that, the market will not favor you. The people who have really made wealth in investment are people who have a long-term approach to investment, not people who are in it to make quick money. And that's why when you see people who are, saying, I want to use cryptocurrency to hammer, I want to use crypto, you're a joker, because that's not an investment mentality. An investment mentality is the one that buys, holds it, and waits until the right time to reap the fruits of the investment. If you're in it for a quick run, you are in the wrong place. Investments need time. Number 5 is reinvest your returns. Reinvest your returns. Leverage the power of compounding. Listen, anybody who is in investment and does not understand the power of compounding does not know anything about investment. Because where you see the beauty or the benefits of investment is when you leverage on the power of compounding. Let me explain the power of compounding for you in very simple terms. It simply means that the son of your investment has been sent to labor again and begot another son, and that son sent to labor and begot another son, right? So the multiplicity of the returns that your returns are getting you is what that power of compounding is all about. So I will break it down for you. Say I have £100 that I invested in a Tesco share in the UK here. And at the end of the year, Tesco's gave me £20 in return for my investment of £100. My return on my total capital now or investment in Tesco will be £120, right? Now, what I do without extra £20 that Tesco gave me in returns as dividend is where the key thing lies. I can now go back to Tesco and say, thank you for this £20, but I now want to reinvest this £120 into that fund again, or into that investment again. Now, when dollar cost averaging, that's right, Dominico. I was coming to that, Dominico. Yeah. So what that does is it then gives me £120, and if I earn another 20% on top of that £120, I have earned £24, right? And I then add it to that £120, it becomes £144. So at the end of another trading season, I'm going on with £144, and then I reinvest that £144 again. Right, and at 20% again, I earn about £28, and that becomes £170. Can you see how £100 became £172? And that is what the power of compounding does. If you do not reinvest the returns on your investment, you are missing out on that power of compounding. Do you know who was that? What's it called? What's the name of this? Very smart man. He said, those who do not understand the power of compounding pay it. Those who understand it earn it. And it is the power of compounding that makes your credit card debts actually multiply, because the banks know how to apply the power of compounding. The more you leave that debt, the more interest it's you. That's where the power of compounding is. But if you flip that coin in your investment and you put that Warren Buffett, not really Warren Buffett, what's this, the Albert Einstein, that's the name I was thinking about. Albert Einstein said about power of compound that those who understand it earn it, those who do not understand it pay it. So if you understand the power of compounding, you will earn it. If you do not understand it, you will be the one paying it to the banks. Number 6 is knowledge or leverage. Knowledge or leverage. And here I'll say, if you don't know it, leverage it. When you go into an investment that you do not have full knowledge of or very good knowledge of, the best way to make the most of that investment is to leverage the knowledge of those who know about that investment. Knowledge or leverage. So if you don't know it, leverage it. There are people who have the knowledge, but they don't have the resources. If you have the resources, but you don't have the knowledge, leverage on the knowledge of those who have the knowledge, but they don't have the resources. You can then invest through those people, or with those people, or in those people, and then you can then reap the full benefits. Or where this works very well also is in property investments. There are people who have a very good knowledge of property investment, but they don't have the cash. They have the time, they have the knowledge, but they don't have the cash. So what they do is that people who have the cash but they don't have the time and the knowledge can now leverage the knowledge and the time of those who know and have the time, and they can go into partnership or joint venture with them, and they will reap the benefits of property investment without even knowing much about property, because they don't know much about properties. So knowledge or leverage is another important principle in investment. If you don't know it, leverage it. Because it's riskier going into that investment with limited or no knowledge of that investment. You are likely going to lose a lot more. Yes, if that person you are leveraging their knowledge requires you to reward them, because that's what it's there for. But if you are too greedy that you want to do it all by yourself, though you do not know anything or you don't know that much about that investment, you are going to shoot yourself in the foot, because in the end you will be the biggest loser. Okay, number 7 is research, research, research. Research, research, research. Any investment you want to make, please take out time to research. Not just the investments. If you're investing through someone or in someone or with someone, take time to research the person that you're even going to do that business with. It might be an individual, it might be a company, right? People who do not take time to research the investment that they're making make a whole lot of mistakes. Whether you're investing in a stock or in a mutual fund or in property, or you're investing in gold or precious metals or cryptocurrency or whatever form of investment you want to go into, how much time have you devoted to researching that investment to find out exactly what you're investing in, who you are investing in, who you are investing with, the company you are investing in, what track records do they have? I have one basic principle, very simple to me. If any company or any organization wants me to do anything with them or invest anything with them, I want to see their 5 years track record, 5 years minimum. If you don't have 5 years track record, it sends a red flag. It doesn't align with my investment principle. There's a very big likelihood I will not invest anything with you or in you, because I want to see at least in the last 5 years what you have done. It is not to say that companies who have less than 5 years track record cannot, prove to be very good companies to invest in. But it's good for you to have a threshold to say, this is what my principles are, and this is my safety zone. And if that is my safety zone, I abide by that safety zone. So always research, and find out where you're investing, what you're investing, and whom you're investing in. Number 8 is for you to review infrequently. Review your investment, but do not make it a frequent review, because the investment you're making is a long-term approach, right? You take your time, maybe once in a year or twice in a year, you just go and review that investment, especially when you are investing in financial instruments, say in mutual funds, if you keep on reviewing your investment every time you're checking your investment to see how it has done, the temptation for you to tamper with that investment will be high. And the more you tamper with your investment, the more you disrupt the flow of that investment, the more you disrupt the spirit of the investment. But if you have set a template for investment and you know what you want to achieve with your investment, and you just keep investing and keep investing, infrequent review of your investment is healthier for your investment than a frequent review of the investment. If every month you are looking at your investment, and then you are responding to news or to the media and all that, shares have gone up, let me go and review the shares I have in my investment, let me sell this and buy this, you are disrupting the flow of the investment. In the long run, it's going to hurt your investment the more. But if you have set out what you want to do with your investment, have a long-term approach to it, infrequent review of the investment is more useful to you than a frequent interruption of your investment flow. Number 9 is for you to understand your risk profile. Understand your risk profile. Are you risk averse? Are you a moderate kind of investor? Or are you an adventurous kind of investor? If you are risk averse, it simply means that you are not the type that is willing to take a lot of risk. So there are certain assets that suits your kind of risk profile. If you're the moderate type, it means you're willing to take risk but not too much, right? And there are certain Thank you so much, Ikem. There are certain kind of assets that you can invest in as a moderate investor. If you're an adventurous investor, it simply means that you can invest in high-risk investments and you not blink an eye. So you have what it takes to absorb all that risk. If you understand your risk profile before you go into investments, that's really, really beneficial. But if you go into investment blindly without understanding where you belong or where you fall under, whether you're a risk-averse person or so risk adjustable to age, yes, risk is adjustable to age. I agree with you, Dominico, but I'm talking of general risk assessment or risk analysis here. People who are risk averse, sometimes when if you are looking at pension investment, for example, when you're getting closer to your retirement age, right? Because of the nature of, because you're looking to now consolidate and keep your investment safe, it will affect the kind of investment you're making. That's a whole lot of a different topic altogether. But I'm talking about the general risk analysis of a risk profile. There are certain people who, because of their age, especially if you're young, right? You can afford to take more risks when you are young because you have a lot of time for the market to correct itself before it gets to the point where it becomes what Sir Alex Ferguson always addresses as a squeaky bum time, you know. And even professional investors or institutional investors, when they're investing your funds, they look at your age and they know where exactly to put that money. But not just about age, right? It's also about your risk appetite. We're talking about risk capacity and risk tolerance here, and that is number 10 points here. If you understand about risk appetite, that's your capacity and your tolerance. Capacity basically means, do you have what it takes financially or resourcefully to undertake the risk you are willing to take? So if you have 10,000 pounds and that's the only money you have, can you afford to lose that 10,000 pounds and still survive and not affect your lifestyle? No. If no is the answer, then you do not have the capacity to undertake that risk that you want to undertake. So you might as well say to yourself, okay, I can only afford to lose, 2,000 pounds without my whole lifestyle being affected. That becomes your risk capacity. There are people who can afford to lose 10,000 pounds and to not be anything to them. You are not in the same category with them. You don't have the same capacity to risk as those people have. And when it comes to tolerance, tolerance to risk is about your emotions. How would you feel? The simple question would be, how would you feel if you were to lose 10,000 pounds? Some might say, I will be gutted. Some might say, that will be the end of me. Some might say, well, it's 10,000 pounds, it's not the end of the world. I still have, something to fall back on. Emotionally, how does that make you feel? There are people to whom losing money basically affects them so badly emotionally that they cannot even think of it. So that's where your risk tolerance comes from. But your risk capacity, about how much of that risk can you absorb, in terms financially such that it doesn't affect your lifestyle. These are things you've got to weigh when you're making investments. And if you do not understand these principles very well, you are going to be making a lot of mistakes, because when you understand the risks inherent in investments, you have to be ready, willing, emotionally and financially to be able to absorb that risk. Otherwise, the risk is too high for you to bear. Number 11 is never risk timing the market. You can't afford to go and be timing the market, because people who spend their time timing the market, not too many of them come back with a very good story. What do I mean by timing the market? People just listen to the news, and then the news tells them that, the market is crashing, and then everybody else is rushing to go and buy because the market is crashing. Listen, by the time that news got to the markets, that trend is already gone. Smart investors, what they do is that they wait for when people are coming out, and then they go into the market. When people are going into the market, they are coming out. Whenever you see the mob rushing to do something, it's already too late. All right? So that's basically you just following the mob mentality. And the mob mentality is not a smart way of investing. Warren Buffett said it, that when people are being scared, that's when you've got to be brave. When people are being brave, that's when you've got to be scared. And that's what smart investors do. Smart investors don't go into market when others are going into the market. When others are rushing into the market, they are coming out of it. When others are coming out of the market, they are... So if you are dependent on timing the market, there is no way you can time the market and time it perfectly. So what you've got to focus on is being consistent and persistent in your investment habits and attitude and principles. As long as you are consistent and persistent, forget about timing them. Whatever the market is doing, you know that this is what you want to do. Just keep doing it, because the market over time will balance itself out and will level itself out. The market over time will correct itself. Whether it's rising now or going down now, as long as you are consistent in doing what you're doing, the market will correct itself over time. The last but not the least is the pound cost averaging principle. Dominic mentioned is dollar cost averaging. In US, in dollar terms, it's called dollar cost averaging. In pound sterling, it's called pound cost averaging. Whatever currency it is you're investing in, it's just that currency cost averaging. Simply put, just keep investing. For example, especially with mutual funds, right? You buy these investments and they are investment units. So those units are priced at certain prices at certain times. So if you are investing a specific amount of money, a certain amount of money into your investment pot every time, whatever you put into that pot, the investment managers will buy the units of investment equivalent to what you have put in there. So all you've got to be doing is just keep investing, keep putting money into that pot, and that's unit price will continue to average itself out according to the volume of investments you're making, and over time you will find